What's up, guys? It's Mr. Fit to Flourish, and today I wanted to talk about how to not get cooked in the markets. How do you not get cooked in the stock market? By the way, shirt off, just finished the workout, so don't mind the shirt, but mind the message, okay? How to not get cooked in the market. Boy, oh boy, let's talk about it because I get so many questions every single day. TikTok, YouTube, Instagram, DMs, 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 DMs after DMs, and I can't answer them all, so I'm making this video. How do you not get cooked in the market? Number one, you need to understand how options work. I trade only options right now. Options are extremely volatile. Trading is a zero sum game. If someone is making money, that means someone is on the other end losing money. And options are inherently risky. What are options? They're derivatives, okay? They are derived from the underlying asset, which is the stock. And if you don't understand what options are or how they work, what the Greeks are, the formula that goes into trading options, don't trade options until you learn this. Go get a mentor, go get a course, go read someone's book, watch a YouTube video. You need to understand delta, vega, theta, all that good stuff. IV, rho. You need to understand all of that stuff. Okay? But the main ones you need to know is you need to know delta and how that relates to the contract price. So as the stock moves in the direction that you want, then delta tells you how much you're going to gain on top of your contract price. You need to know that. You need to know theta. Theta tells you how much money that your stock will lose for every day that, or your contract will lose for every day that you hold that options contract. IV, implied volatility. You want it to be less than 50%. Over 50%, then your options contract price can fluctuate. So if it's an earnings play and it's over 100%, IV is over 100%, then your contract can go from $500 that you bought it for, and overnight it can go to zero. So you need to understand the formula and how it relates to your contract when you buy it. Okay, that's how you don't get cooked. Number one way to not get cooked. Number two, you need to understand that when you put on a trade, you're accepting the risk of that trade, or you don't put on the trade at all. You accept the risk of the trade. So if you're playing with options, you need to understand that that contract can go to zero immediately. It can go to zero. Okay. So whatever you put in, it can go to zero. If you can't stomach that, don't trade. Don't put on the trade, or just don't trade options. Go get a job. Go get two jobs. No, but seriously, like you need to accept the risk. And if you don't accept the risk, if you're crying about it, if you're following someone's trade and you end up crying about it, go get a couple jobs, okay? Because when you put on that trade, you're accepting the risk because options are inherently risky and they can go to zero at any given time. At any given time. So again, accept the risk of the trade. And this brings me to the next portion. And if you're putting on the trade and you think that you've accepted the risk, but your stomach is turning as the trade is going on, you're getting anxious, your heart is beating really fast, you're paying attention to every tick on the stock, your trade size is too big. Your trade size is too big. Okay? You need to reduce your port size by 50 to 60%. Reduce your port size by 50 to 60%. And this will help you tremendously. Tremendously. How? Well, it's going to allow you to sit in the trade longer because you won't really care about the little amount of money you put in. So let's say you usually put in $500 and your stomach's turning. Well, put in $200 and you'll be like, oh, okay, it's just $200, whatever. If that goes to zero, all right, I still have this 300 that I didn't put in yet. Okay, reduce your trade size, and you'll see that once you reduce your trade size, you'll be able to focus on the actual chart and the actual setup a lot more than just focusing on the dollar amount and being so scared that you might lose that. The more scared you are to lose the money, the quicker you'll lose the money. Okay, that's just how it works. That's how it works. Energy flows where attention goes. Where attention goes, energy flows. If you're focused on, oh shoot, I might lose this, well, oh shoot, you're gonna lose it. Okay, but once you reduce your bet size, I promise you this is gonna transform your trading. Cut it in half. Whatever you're putting in, cut it in half. Whatever you're thinking about putting in, cut that in half. And then you'll be like, oh, okay, I don't care. and then you'll focus on the chart and the setup, and you'll start to win really big, really big. And it'll allow you to stay in the trade a lot longer because you're like, oh, okay, well, if this goes to zero, I don't care. Now you're really accepting the risk of the trade because your bet size is small enough where you can accept losing that amount if you lose. But if you win, you'll be holding on to the trade a lot longer. So it'll go in your direction a lot more. And your percent yield, your percent gain is going to be a lot bigger. I promise. And then number 3, please don't get cooked like this. Please don't get cooked. We talked about not knowing how options work. We talked about accepting the risk of the trade. Don't trade 0 DTE, especially if you're like not profitable or if you don't know how options work. Don't trade 0 DTE. I know you see like how it can go from like $10 to like $1,000 real quick, or 1,000 to 10,000 with 0 DTE. 0 days to expiration is what 0 DTE is, which means it's an option contract that expires the same day. Don't trade that stuff. Very, very volatile. And the only time you should be trading 0 DTE, 0 days to expiration options, and is when there's a ton of momentum in the market. There's straight directionality, like it's a ton of momentum. Then you can just trade in the direction of the trend. But if it's chopping and chopping, well, your contract is going to lose a ton of money. And that's all I see people do because a lot of people don't have setups, which takes me to my next point. If you don't have a setup, you need to get one ASAP. If you're just trying to trade anything, that's why you're losing. You see the stock going up, you're trying to trade it. You see it going down, you're trying to trade it. That's not how to trade. That's not how to trade. What happens is when you're trading, you're waiting for opportunity. You're waiting for your edge to show up. What is edge? Well, edge is simply a higher probability of an outcome based on a series of events on the chart. Basically meaning that there's a pattern that's going to show up that you usually see that works really well, that's going to yield a win for you. It's going to yield a win for you. So you need to be trading with a setup. Okay. There's a lot of people who are asking me about advice and all this stuff. And I noticed, like, I'm like, dang, like you're asking me all this stuff, and it just shows me how much knowledge you have of the market. It shows me how much knowledge you have. Like a lot of the retail traders I talk to are very, very good traders. Well, in theory, they're very good. They know a lot. The only problem is they're trading 12 setups, and they don't realize why they're losing all the time. Because you're trading 12 setups. You're waking up at 9:30 a.m. and just trading when the market opens. You don't know that the market has a 10 a.m. reversal and 11 a.m. reversal time. You're just trading with big money at 9:30. You don't do that. You don't just get up and just try to put on a trade. Like a lot of people are just too anxious and just like, I want to, 9:30. Okay, the market open. Let me trade. Like, what are you doing, bro? You're cooked. You're cooked. Right? And you're wondering why like your P&L is so trash. Wait till after 10 a.m. This is the first fix. Wait till after 10 a.m. and start to trade then, because you'll have some structure to go off of. You'll see like, oh, okay, look like we broke out of this opening range at 30 a.m. In the first 30 minutes, from 9:30 a.m. to 10 a.m. We broke out. Now there's movement in X direction or this direction, instead of getting faked out in the first 30 minutes of market open. Like you're not waiting for a setup, you're just jumping in. That's the first reason that 99% of retail traders are cooked, because of that. But you do need a setup. So what's your setup? The opening range breakout, an ICT silver bullet, a supply and demand strategy, a EMA crossover, a VWAP crossover, a breaker block. Like what's your strategy? You need to pick one, and you need to master it and stick to it. Stick to that one strategy. When it presents itself on the chart, then you jump in. If it doesn't, if something else is happening and price is going up way fast, but it's not your setup, then just leave it alone. It's not your time. That's okay.